This is the CEO Barbecue. My name is Antonio, and today we're looking at a high-grade gold project in Quebec's Abitibi, or at least we're getting an update on a high-grade gold project up there from Matt Manson, the CEO of Radisson Mining. As always, this is going to be a long, in-depth conversation, so feel free to use the timestamps provided in the description and on the time bar to better navigate the video. And if you want just a quick 10-minute summary of this conversation, go to resourcetalks.com for the written version of this and all of our previous interviews, as well as consider subscribing to our free email list, which sends a weekly summary to your inbox with all the interviews from the prior week in bullet point summaries. And before we get into anything here, I would like to warn you that we have received monetary compensation for the production of this video from the company that's being interviewed. Please understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research, and you should treat this as an advertisement instead. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. And please only proceed if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, so before continuing on, please talk to an investment advisor with a good long-term track record because your capital is at risk, and I am not a financial advisor, and I do not have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Radisson is listed as RDS on the TSX Adventures Exchange, where over the last 3 months, the average volume has been about 180,000 shares. The stock's 52-week high is 39 cents and its 52-week low is 16 cents, with a market cap of just under 130 million Canadian dollars today and just over 380 million shares outstanding. This is now a 34-cent stock with a 50 and a 200-day moving averages at respectively 33 and 29 cents. Now, I'm not doing a full company overview here today because Matt and I have had numerous conversations over the last year. So if you're new to the story and want to listen to the initial CEO Barbecue, please go and look at the Radisson playlist that will be linked in the description of this video, where you can find all the previous conversations in one convenient spot. And that all said, Matt, I really am looking forward to catching up today. So thank you for sitting down with me.
Thanks for having me on, Antonio. Looking forward to it.
Always a pleasure. And it's been only about 3 months since we last spoke, and I'm looking forward into going into some of the details of your last. You've had 4 or 5 news releases in between, including some more drill results, an increased drill plan on the back of a financing, which is an upsized financing. So we'll talk about all that. But even with that, the stock is not really moving. It's actually down a bit since the last time you and I spoke in, I think it must have been February, and the volume has been on the lower end as well. So what's going on? Why is the stock not going up?
It's always difficult to be a pundit on your own stock. We had a great 2024. When I came in, the stock was about 16 cents. It was at that year low, and it was about a $45 million market cap. So had great success last year and moving it up to where we are right now. I think we're consolidating here in the sort of 33, 34, 35 cent range. That consolidation allowed us to execute on a pretty efficient fundraising. We did 12 million, just closed a couple of weeks ago. Obviously, the people who bought that stock are buying it because they think the stock's going to move up from there. So we're doing everything we can in the business of the company to see that happen. And certainly in the business of the company, it's going very well.
What do you think of this valuation? Fair value? Well, I suppose you're supposed to tell me it's undervalued, but how do you look at it and how do you justify that?
That is a really topical question, and it's an almost impossible question to answer in this market. And I'll tell you why. I was at the SMI conference in Zurich a few weeks ago now, and Swiss investors have metrics of valuation right up front in their in their list of questions for you. A North American investor might sort of say, well, how's the business going and how's the drilling going when a drill result's coming out? The Swiss investor will come to you and say, well, listen, explain why your valuation is what it is. And so I got that question a lot in Zurich, and it's an impossible question to answer because we're being valued right now at about $100 an ounce, call it that. And for companies like Radisson that have resources but have yet to put out an economic study that allows you to have a NAV and then so a discount off that NAV and use those types of metrics. Right now, we're being valued on dollars per ounce in the ground, and so $100, and obviously too low. But that is a metric that might have been used, 5 years ago when gold was at $2,000. So now gold's at what, 3,300, 3,400, and so the deltas that are involved now in these numbers are quite staggering. So, that is between a $2,000 gold environment a few years ago and let's call it 3,400 now. That's $1,400 US per ounce of value for ounces in the ground. So, so does that mean that, is $100 an ounce valuation for an exploration project that's growing, that's in a crackerjack jurisdiction like Quebec, that is adjacent to two big and hungry mills, that's on a brownfield site, beside a highway and a power line? Of course, that's a silly valuation. Despite the fact that we've almost tripled the valuation in about 12 months, it's still a silly valuation for this business, right? And so should companies like Radisson be valued at $200 an ounce or $500 an ounce or $1,000 an ounce? Yes to all of the above, but how do you do that? So the question that's impossible to answer from to the junior mining CEO, even the mid cap producing CEO, is why is your company valued that way, and when's that going to change? You can look at cash flow multiples of producing gold companies in a $3,400 tariff world, and compare that to the cash flow multiples of other types of industries and other parts of the economy, Tesla or whatever company you want to pick, and there are ridiculous gaps in valuation. So that's a bit of a I'm not answering your question when you answer me. I'd like to give you a direct answer, Antonio. It's a bit of a cop-out answer, but it is the fundamental challenge of the gold industry right now, is how do we get valuations that properly reflect our business, the fundamentals of our business, when there's been, again, $1,400 of margin created in our business in the last 2, 3, 4 years with the commodity price. It's probably not going down anytime soon. And the juniors with quality ounces in the ground, financed, moving forward, we're growing our deposit, mills nearby, roads, power lines, all of the above, $100 an ounce. Should we be $150 an ounce? It's almost like a silly argument. So silly discussion. So that's how I answer that now, right? And that's how I was answering these investors in Zurich, right? If ever there was a bargain in the global economy, if ever there was a bargain investment, it has to be, people with ounces, quality ounces in the ground in this type of environment. But it's yet to take off. And so, I can be very proud of the fact that our valuation is 3 times what it was 11 months ago. And that's the work we've been doing, and it's the communication we've been doing, and it's the people that we're putting forward in this company. But still, it's $100 an ounce. Now it's $120 an ounce, say. So long answer to a good question, but that's probably the best I can do in that.
Well, it's so EV or market cap to ounces in the ground, by far not my favorite valuation ratio. Do we have better ones? That's probably a discussion for another time, but let's maybe focus on why you think it should be more, and we can take it from the financing onward. initially you intended to raise $7 million. We announced that you had a fully subscribed financing for $7 million on April 22. And then the next day, so April 23, you announced an upsize to $12 million. You've done that before. I've asked you the same question before, but so it's $5 million more than what you initially went for. How come? Why take 12 if you thought you could do it with 7 first?
Well, a lot of this is to do with the mechanics from how you raise the money, right? So, and there are certain prescriptions from the regulator on how you raise the money. So, number one, this was a non-broker deal. It was a private placement, a 4-month hold paper, non-brokered, which meant that we weren't entering into a contract with a broker to sell a certain number of shares. How that deal came about, we had raised money in October. We were funded for the exploration program we're doing this year, but we're having success. And so clearly, additional money, use of proceeds, additional drilling, doubling down on the deep exploration, which we'll talk about, and which is what we're doing. Obviously there was good work to be done there. So we had an approach from an existing shareholder who wanted to make a sizable investment, and this was an investment that we wanted to entertain. And so the mechanics of that type of deal, non-brokered, is that you announce you are doing that. But by announcing you're doing that, you're then public with the structure. So we had a flow through a share, and we priced, and we had a hard dollar share priced. And we were willing to then to expand that deal. And non-brokered, again, one of the benefits of doing non-brokered is you're controlling the pricing. You're not arguing with a broker about, what the pricing of the deal is. And the broker very much is quite often, obviously representing their interests and their risk. So we are setting the price. There was no warrant on that deal. And then we opened it up, having established that structure. We didn't want to raise too much, but there was an easy and quick and quality book of an additional $5 million to take it up to 12. And at that stage, we've got a good balance of investors. We've got a good balance of money, hard dollar expenditures in the company, flow through for money in the ground. Use of proceeds, we can certainly spend that money. The price was right, the dilution was good. And so, I shouldn't probably say good along with the word dilution, but dilution was fair. So happy to extend to go to 12. Antonio, we could have done more. We were oversubscribed at 12. And we had discipline, right, to keep it at 12, but we could have done a lot more. And so yeah, twice we've done it that way. Frankly, there's a very, very healthy circle of existing investors in Radisson. Michael Gentili, a lot of your viewers and listeners will know. He's a director of the company. He's a major shareholder. He's got a big presence, and he's got a following, and he's got a circle of people who like to co-invest with him. So that's a very important aspect of our story at Radisson. So in my previous roles and with previous hats I've worn in the mining business, I've tended to always do brokered financings. And the benefit of doing a bought deal, broker financing, is that there's very low risk to the company in terms of raising the money, right? You're going out for 20, 30, 40, $100 million of bought deal. You're going to get $100 million. The broker is taking risk to give you that money. The downside of that is the broker is going to tell you what price this is going to be and what the unit's going to be, and quite often that's driven by the lead order. And you can have only so much influence in who's actually buying the issuance, because the broker in a bought deal was wanting to get off that risk. So you can end up with some fast money, hedge fund type money in the book. So doing it the way that we've done it twice now at Radisson, we know who our investors are. We set the price. We listen to our investors. We come to the right place. We have much more control in the process. And then we can develop that continuing relationship with the people that are about the issuance. So, been very successful for us in doing it that way. I said to somebody recently, when you saw companies doing non-brokered financings in the past, quite frankly, it was because they had to. right? Because the brokers weren't willing to actually take on any risk and working with them. So they'd go out to, they'd work very hard to find a number of investors who are willing to put some money in. They do a sort of a small non-broker financing. I think now when you see companies like Radisson doing a non-broker financing, it's just a better way to do it,
Yep.
right? And we can raise quite, you see some quite sizable deals that are non-brokered, and on good terms. I think still, if you're doing a $50-100 million deal and you're bringing in some of the larger institutions who prefer to work with the brokerage world, then you're still doing those types of deals on a brokerage basis. But for us at this stage, raising that type of money in this type of way, it works very well for us.
Uh, totally agree, especially in Canada when there's flow through and whatnot involved. Not knowing who gets on the back end of that could be a story breaker. I mean, maybe the
Yeah,
rocks work out, the stock doesn't work out because you didn't place it in the right
yeah.
hands. Totally agree. I have a personal quarrel against broker deals in the first place. Also, a bit of a personal quarrel against warrants myself. So I'm glad to see or that you might agree, especially on the warrant part as well. But so you're mentioning Michael Gentile though. Who else is giving you, like, is there a lead order for the 12 million bucks, or who I mean, yeah, who's giving
Yeah,
you that money without?
there was a chunky lead order there. Obviously, we got to be discreet as to these things. So,
Yep.
we don't have anybody in our share register above 10%. So nobody has a regulatory obligation to be a reporter of their shareholding. So we respect the privacy of everybody. But it was a quality order, existing shareholder. Very happy to build a financing around that order. And that's how that came about. And now we're going to end May with about $16 million. The deal closed about 2 weeks ago. We'll have about $16 million in the treasury at the end of this month.
Mm-hmm.
And given the very low overhead in this company, given the very efficient drilling costs that we have, even with our deeper drilling, we're reporting a drill cost per meter well below our peers, and that's just because of where we are. That's location. That $16 million is going to go a long way. I mean, we're going to get a lot of drilling. We said 30 to 40,000 meters more on top of the 22,000 that's already been committed to this year. So that's another 50 to 60,000 meters in this deposit that we'll be drilling this year and well into next year.
We'll definitely get to exactly what you'll be drilling there, how much, how deep, and so on in the latter part. Did insiders participate in this financing?
Yes, all three of the senior managers of the company participated, and we've all done our SEDI report. So yeah,
Hmm.
we've all, and I'm now up to about 1% of the company. I think I'm up to about 3.6, 3.7 million shares personally, all of which has been bought on the market since I joined the company, or through financings like that.
Hmm. So you're taking a chunk of this finance. Is that something you're going to keep doing? I mean, are you going to keep stepping into financing, so buying in the open market?
Yeah, I think so. I'm lucky enough to be able to do that personally. I'm not independently wealthy, such that I work for a living rather than live to work. Uh, uh, but yeah, I mean, we're very optimistic about. I mean, that financing had the CEO, the CFO, and the VP exploration all buying stock. And when the VP exploration is buying stock, that's usually, no offense to the VP explorations out there, but that's usually a good sign.
Hmm.
Because they're not doing it through obligation, right? The CEOs and the CFOs feel obligated to do it, but the VP explorations and the engineers of the company, or when they're buying stock in the company, it's usually a good sign.
How many shareholders do you think you have right now in total?
Oh, I don't know. I mean, you
Well,
know, yeah, I mean, hundreds, at least, probably in excess of 1,000, if you
I'm
count
just
everybody, I'm sure.
I don't need a specific. I was actually thinking maybe ballpark. It's kind of a spontaneous thought too. I don't get much of those, so I thought I'd just shoot it out. But I'm thinking about future financings. Do you think it's going to be as easy as just picking up the phone in the future, say, a couple of hundred times or whatever it might be, and getting people to finance you again without warrants, without having to pay fees to brokers and so on? Look, how do you see that for the future financings?
Yeah, well, I think right now for where we are, yeah, that works very well. Look, when you're building a mine and you are raising much larger sums of money, hundreds, and I've done that. you're not there's a number of different ways of doing that. You can there are certain all of which have been a success. I'm not going to prejudice any different model, but there is the model of just going out and doing that all public equity with a broker, where you've got a whole bunch of $5-10 million orders to raise 100 or 200 million, and you're doing it. You're reaching the institutional market in Canada, the US, and Europe, sometimes in Asia. And you've usually got a lead order in there, and you end up with a whole bunch of shareholders who are 2, 3, 4% in your share register, right? And so if you look at most of the and that results in the share registers that you will see in companies, the mid-cap companies out there, the Centeras or the Westhomes or the IM Golds or the New Golds, or those types of companies will have similar names in their share registers, the Fidelities and the Van Eycks and the Franklins and the BlackRocks, and they're all kind of 5% and down, right? Their shareholding. Then you end up with a share register that looks like that. Our shareholders registered at the moment doesn't look like that, right? We have a different type of investor. We have a lot of high net worth individuals. We have institutional, but we also have a mix of regional stakeholders who bought shares in the past. We have insiders. We've got 9% in total in insiders.
Mm-hmm.
So it looks a little bit different, right? So, but then there's also the model of you're going out to chunkier investors who are maybe doing $50 or $100 million, or you're going out to a private equity type model which could be chunkier again, and you end up with something that is where you've got strategic shareholders of bigger shareholdings. I can think of a couple of companies out there, probably should be naming companies, but that have that type of share register. Again, has been very successful as well. So different ways currently to access as a public company the larger capital sums that are required for larger lifts in this business. To be perfectly honest, what we've seen in the mining business in the last few years is a drain of money coming away from the actively managed portfolio managers. I mean, you've heard this story 1,000 times, right? So much more money is going into passive investment rather than active investment. So a fund manager sitting with $1 billion or $2 billion or $500 million of actively managed portfolio that they can put into a new issuance or an existing company, that's been a struggle, right? That market has been tightening, especially for the juniors, right? The types of portfolio managers that are mandated to actually go downstream and pick up some of the earlier stage, higher risk investments. Has been a challenge. So what we are doing has been very successful for us. Really happy with how it's worked out now. Twice we've done it, and I don't see that changing for again Radisson for where it is right now, which is drilling this deposit and bringing through the scale attributes of it.
Still no strategic or no known strategic holders of the equity, though. I mean, is that by design, or is it too early for, say, an IM Gold or an Agnico or anyone else that's active in the region to get involved here at the equity level?
No known. I can't speak for any strategic. I can just speak for Radisson. Mm-hmm. We haven't invited it at this stage. I think we're quite comfortable not having it. We have a lot of potential, partners to go to the dance with, and don't necessarily need to tie up, we feel. But yeah, probably as much as I can say about that.
That's fair. I feel like there's no room to push you any further on that. So let's talk more specifically about what you'll be doing with this money here this year. Where do you go? What do you drill? How much do you drill? You said, 66,000 meters. Where is that going to be spread across?
So I'll tell a little bit of a story here. So when I came in last July, we had a 1 million ounce resource, and it was clearly getting bigger. But I think the company at the time was having a kind of a small step out, big step out type fork in the road. And this is very common in exploration, right? Are you going to nibble around the edges of a resource and slowly grow it? Or are you going to take the big brave step outs and hit things? My previous role at Marathon Gold, when I went in there in 2019, we had 2 ore bodies and a gap in the middle. And it was exactly the same discussion. Do we do small step outs growing out from the known deposits, inching into the undrilled gap? Or do we just put a hole right bang in the middle of the undrilled gap? So we put a hole right in the middle of the undrilled gap and hit a 3rd ore body, which became Berry, which became very important in the history of that project and in the development of that project. So that was a big gap philosophy. We're doing the same at Radisson. Rather than nibbling around, we were, and I don't, again, want that to sound prejudicial, but we were doing small step outs, filling gaps in the existing resource, nibbling around the edges of things, having success, but that drilling wasn't really going to change the narrative for us, right? So the obvious opportunity at O'Brien was to go down, right? And starting in the fall, we began doing these big step outs. Probably the most notable and illustrative step out we did was the first hole that we drilled below the old mine. And so the old mine went to 1 kilometer deep. In 70 years since mining stopped at O'Brien, nobody had drilled below the old mine, as amazing as that sounds. So it was an obvious hunt. We put a 1,500 meter hole in. We went 500 meters below the previous data point, which was the bottom of the old mine. All we wanted to see was the geological formation, the howsoever mineralization, which is called the Pichet Formation. We hit that, but then we also hit a mineralized zone that was 8 meters, core length of 30 grams. Most of that was in this really hot core of 242 grams in the middle, but the whole zone was mineralized with gold, which is how our deposit presents itself. 6, 8, 10 meter core length zones, which end up being like 4 or 5 meters true width, with a really hot VG kind of hit in the middle, but the whole zone is mineralized. And then we end up with stopes that are going to be 2 to 3 meters kind of wide when we mine that thing. So hit that, 337. Put that press release out in December. That was in the middle of nowhere, 500 meters below the old mine. We've also now hit doing that 170 meters below what we call trend 1, similar types of grades, similar types of presentation of the mineralization. In April, we put out the first 3 wedges off the deep hole below the old mine, wedges 1, 2, and 3. They all hit, and they all hit in such a way that showed the development of 4 different mineralized zones, 4 veins. Those 4 veins tie into 4 veins that were visible in the mapping at the base of the old mine, 500 meters above. So the continuity is there, as we might expect. That's what this deposit always shows. Put that into the market in April. And then we raised the money. We're still waiting for more drill results to be put out, assay results. But what we did have to show the market last week, and you're very good at illustrating these talks with graphics. So put up figure 2 at this particular moment on our press release from last week. Figure 2 is the presentation of all the deep holes and wedges we have done below the old mine and below the existing resource. The black holes have been press released with assays. The red holes are in the lab. And all the red balls on that graphic is visible gold. Now, when we show visible gold here, we're not trying to, that's not a proxy for assay results. We're not trying to predict a specific hole and a specific assay by showing that. That's a proxy for geology. Every time we hit VG, we're in the zone. We're in these mineralized 6, 8, 10 meter wide zones that have gold. Right. So gold is the best indicator for being where the gold is. And so that's what that's showing. And you'll see that we've now drilled 8 holes below the old mine, 7 wedges and 1 pilot hole. And I'll talk about that methodology, but that's what we're doing. So you got a cluster now of 8 pierce points that have splayed out, all covering an area of several, 250 meters diameter, right below the old mine, and every single one of those holes is hit. There are, and some of them hit in multiple zones. So that, and then you see the red balls below trend 1. You see more below trend 2, and then we've drilled a hole now below the westernmost part of the old mine, which was a little bit thinner and scratchier than the main stopes of the old mine. That's hit as well. right? So this methodology of big step outs, going down, and then with a pilot hole that we can then wedge off and use directional drilling to come in, get a cluster of pierce points. It's working out really well. So those red holes are in the labs. Again, forward-looking statements, warning here, we don't have assays that go with those hits, but we wanted to show that because that is the rationale for the financing. And that's the rationale for now doubling down on this strategy of going down with these big step outs, because we are successfully hitting mineralized intervals with gold in multiple locations. And we said in that press release that as explorationists, you got to have a target, right? We got 1 million ounces right now in two different indicated and inferred resources combined. But what is the mineral inventory target in the official parlance of this? Is what's our exploration target for this project? And that's 3 to 4 million ounces. And we said that in that press release. We're going out with those numbers because that's what you get if you take the old mine and you take the new resources just in that central portion, trends 0, 1, and 2. You look at the ounces per vertical meter and you extend that density of mineralization to 2 kilometers. If that's what you get, and 2 kilometers is what we think our natural floor is going to be in this project. And if the system continues to that depth, what do you get? You get between 3 and 4 million ounces, right? So that number is really interesting because one of the 2 mines next door to us, Westwood, that is a 4.5 million ounce deposit. In terms of its historical production, its current reserves, and its resources, it's about 4.5 million ounces. Really good grade, better than ours, but 4.5 million ounces in terms of scope. If you look at what we are developing here, we've got 500,000 ounces of historical production, and we've got an exploration target of up to 4 million ounces on the basis that our resources are going down, and this drilling is working out. Proof of concept is good. We're heading that way. So if we get that, big if, but if we get that, it's 4.5 million ounces. The scope of our project is the same as that thing next door. So that is an eye opener for people with O'Brien. And Antonio, this is a really important point I'm trying to make when I talk to everybody O'Brien. You introduced Radisson at the beginning of this call with high grade in Quebec. And O'Brien is high grade. We got terrific grades. But O'Brien is famous for being very high grade. It's famous for having these museum quality visible gold samples. And we talk about this. We've got these visible gold samples all over our IR deck. We discovered one of these super high grade zones in December, the jewelry box. And 1.3 kilograms per ton over these relatively short intervals. O'Brien produces that, is real. But when you talk about high grade, you're implying small, right? Most super high grade deposits are actually quite limited in scope. They're kind of bespoke projects. And 5 years ago, everybody wanted super high grades because remember, the gold price was low and the investment was thin and margin was the most important thing. And miners were being told to fix their balance sheets and don't go for scale, but go for margin. And so everybody was like, wanting high grade. And so people think of O'Brien as being the super high grade project that implies limited scope. We don't think O'Brien is limited in scope. We think it's upwards of 4 million ounces, and with a lot of tons there. We think it's a big mineralizing system, yes, it will have these areas of super high grade, and the miners will really enjoy discovering and mining. But what's really going to drive value in Radisson and O'Brien is a realization that there's a bigger mineralizing system here. We're hitting it. We're stepping down, we're hitting it, we're heading towards those bigger numbers. It's going to take us a lot of drilling to get there, right? This type of deposit requires a lot of pierce points, but directionally, our eyes are getting opened. We think it's there, and at that moment, we're not some sort of bespoke, curiosity that has produced museum quality samples. We're actually quite a major new Abitibi mining project that's on the horizon.
You're bringing up a couple of important and interesting points to talk about here. I'll go back to that figure two from your news release first, though. It looks to me that it is the East O'Brien block that carries the project as it stands today. So, but as far as I understand it, that's not what you're going to be focusing on too much in the immediate future. You talk about Thompson Cadillac instead of growing and
Yeah.
improving what you have on East O'Brien. So where is the drilling going to be focused on? Is it going to be that portion that carries O'Brien as it is now, so East O'Brien, or do you go to other spots as well?
So we're going to have 4 rigs, and we're just in the process actually of formulating the detailed plan. But it's going to be 4 rigs. The core focus is going to be on the O'Brien mine, which we call Mine West and Mine East, and then trends 0, 1, and 2, which is really trends 1 and 2, for reasons I'll explain in a second. So that is kind of the central slug of the deposit. That's what gets us our 3 to 4 million ounces, that zone, if we continue down to 2 kilometers. Trends 3 and 4, there's resources there, but it does get thinner as you go out to the east, right? So I get quite often asked, why do trends 3 and 4 not go down quite as deep as trends 1 and 2? And is that because it's a function of where you're drilling? And it is a function of where we're drilling. But any smaller company with limited drill funds tends to go where you're getting the best success, right? You don't really have the budget or the license just to put in a grid. You end up chasing the better stuff. So yes, it's a function. The way that resource presents itself is a function of where we've drilled, but where we've drilled is a function of where apparently the better results are happening. And so primarily of those 4 drills, 3 will be doing pilot holes. Well, 4 initially will be doing pilot holes and wedges to give us as much coverage as possible in that area. And we also said that as well as doing these big step outs, we want to now start thinking about what it takes to get an inferred resource from all this material. And that's probably a 50 to 75 meter drilled spacing. So we want to make sure that we're getting that, so that there will be the ability to do a resource on this material. Thompson Cadillac is everything to the west of the old mine, and there's resource out there, but it's only been drilled to shallow depths. And there are people in the company who are big fans of Thompson Cadillac. There are people who have been working on the project for a while that are of the strongly held view that hasn't been properly tested. And the mineralizing system continues that direction. So we're going to put in some blind holes. We're just going to put a bunch of holes in, probably 400 or 500 meters depth below the old Thompson Cadillac. Thompson Cadillac is an old shaft. In the Abitibi, especially on the Cadillac Lower Lake break, you have a lot of these shafts. Some of them will date from the 20s or 30s or 40s. They can go quite deep. They've been hand developed, sort of, Garamperos style, but back in the 30s and 40s. And then drifts are put in. Some of them can be quite extensive. We've got 2 of those on the property, Kawagama in the east, Thompson Cadillac in the west, and then O'Brien itself was a proper industrial mine. So Thompson Cadillac in the west, yeah, we're going to see what's out there. If we're hitting below Thompson Cadillac, then that's a real game changer. And we've got the resources, we've got the drills, we've got the people. So we're, again, big step outs, taking a risk. The risk when you do this is you get nothing, right? So we're going to take that risk and see what's there.
Again, looking at the and figure 1 as well, by the way, from that news release, is also curious. I've got it here looking at it right now. But how much of all the drilling is going to be below 1,000 meters from the, again, 66,000 meters?
A lot of it. And one of my directors, I was talking to him this morning actually, and he sort of said, when you're talking about the deep drilling, make sure you're articulating how efficient it is in cost. Because what we're doing here, sometimes when you talk about deep drilling, everyone's thinking, oh my goodness, it must be horribly expensive. What we're doing here are these deep pilot holes. We'll put something down that's 1,500 meters, and then we'll wedge off that, and we'll do shorter holes of just a few hundred meters, and we'll use directional drilling to guide the hole into the right location. So I think we're right now doing about $260 a meter for these, for this type of drilling, Canadian, all in, which is, even though we're drilling to those types of depths. And we are going to go to 2 kilometers, and we are going to wedge off a pilot hole that goes to 2 kilometers. When you're wedging off a hole, you're usually kind of going shallower with the wedges than the pilot hole went, although there are different ways of doing it. So we'll go that deep, but the drill costs are, people shouldn't think that we're just going to break the bank with cost to do that, because again, using these pilot holes and doing wedges is actually relatively economical, and we are able to do that because the rock quality, the RQD on the core, which is a technical, reference to the quality of the rock that you're bringing up in the core, is very good at O'Brien. We don't have bad ground, so that we know of yet. So that means then you can use the same pilot hole for a lot of wedges. We're expecting to get 10, 12, in the best case, or wedges off a pilot hole, and you're pulling rods up and down so much on the original pilot hole that if you've got bad ground, you're gonna decay that hole pretty fast, and then you start losing drill rods, and we haven't had that problem. We were able to do a lot of wedges off these pilot holes. That bodes very well for the future for mining. When people ask me about ground conditions and future mining scenarios, I point to how many wedges we're doing off pilot holes. So yeah, cost efficient, and I think almost all of that 30 to 40,000 meter drill budget is going to be spent, other than a few holes around Thompson Cadillac, other than a few holes drilling around the jewelry box that we think we've rediscovered. Almost all of that's going to be deeper holes below 1,000 meters.
What do you expect to encounter at that depth from the perspective of everything? I mean, structure, vein, morphology, metallurgy, and everything else that's holding East and West O'Brien together. What would you expect do you expect it's still that all of it is still going to hold up, or what do you expect to encounter at that depth?
So in our press releases and in our PowerPoint presentation, you'll find some cross sections of the geology of this deposit. The ones that you've just presented previously are the long sections. When you look at the cross sections, the geology is really simple. You've got the Cadillac Larder Lake break dipping uniformly about 80 degrees to the south. You've got a big slug of what's called Cadillac sediments to the north, big slug of what's called Pontiac sediments to the south. And right up against the Cadillac Larder Lake break, you've got a sandwich of what's called the Pichier group, which are metasedimentary, metavolcanic porphyry rocks, which form this set of planar, it's a sequence that's a planar sequence of sandwiched rocks up against the main contact. So the cross section I have in mind is the one where we've drilled that big deep hole, 1,500 meter hole below the old mine, and we show the old stope of the old mine in the Pichier, and the main stope of the old mine ran down through the porphyry unit. And then 500 meters below, we're showing the pilot hole and the first 3 wedges, and they're all hitting right on the same unit, and we're getting exactly the same geology. And this is all you can take a ruler, Antonio, and just draw a straight line straight down. The geology is really simple, right? Really simple. And that is a real to scale cross section that demonstrates, it's not a cartoon. It is demonstrating the simplicity and the regularity of the geology. So we are expecting that, and we have that everywhere, right? And we're expecting that down to 2 kilometers. And so, and we get the same type of mineralized zone. We get 6, 8, 10 meter wide zones, and the zones are mineralized with quartz veining. They have extensive biotite alteration, and there's disseminated pyrite, arsenopyrite, and then there's gold. And usually there's a really hot zone in the middle of the zone, which is with impressive visible gold. So that's what we get at surface, and our deposit goes to surface. That's what we get at 1,500 meters depth. Straight line down, connecting the dots all the way, 80 degrees. And that's what we're expecting to get everywhere. It's as simple as you can imagine. We're not dealing with complex macro geology here. we see smaller scale structures within the individual mineralized zones. We can see folding of veins. We can see veins coalescing. That's what we think the jewelry box is. It's a linear zone formed by two vein sets that are coalescing. So on that scale, we can see detailed geology, and we have all the mapping from the old mine, from every development level. So we have the benefit of all of that. We understand the continuity of the mineralization at the stope scale really well. We know we can mine this. But on the macro scale, for targeting a drill hole down to those types of depths, it is remarkably predictable.
I am looking at these, or trying to look at these in real time, and try to make myself sound smarter in my questioning as you're talking about them. But when do you think the first news releases are gonna be from? Because you said you still have some other assays to come from that.
It's going to be pretty steady. We're doing it every few weeks. The last dump of drill results was in April. It's pretty steady. So, not before very long, I think is the answer to that. I don't particularly want to be guiding to specific, dates for releasing drill results, but it's pretty steady. And it's going to be pretty steady all the way through the 26th. And we tend to wait until we've got a cluster of holes to put out. We have put out individual holes or 3 holes. In April, we put out 3 holes there because they were important. They were telling a story. They're all in the same place. But generally, we put out batches of holes, and I'd expect we'll be doing that relatively soon. But it'll be steady, I think, from now right through 26.
Right. Okay. And that's actually, it's been more or less one of your mandates. I'm looking at a chart here with the prices, the price chart with the news releases on top of it, actually. And it seems like, you're looking at a 2-year price chart, which goes further back to before you joined the company. But ever since, it started grind up. And it seems like essentially you like having a continued news flow personally. That seems like it's more of a bit of a personal mandate. Is that fair to say?
Yeah, I don't think I don't think we're doing it that differently than anybody else does it. We press release every hole, so we're not being selective in what we put out, what we don't put out. Sometimes we change the order of disclosure a little bit because we're trying to highlight a specific story as to what's going on. But you can be assured with Radisson that every drill hole gets published, and usually in the order that they just come back from the labs, and so we get to the stage where we have a critical mass, and then we put that out, and we like to put drill results out again in a way that gives direction to shareholders as to why we're doing what we're doing and what the what the story is and why it's important. You can see some drill results press releases sometimes, which is just like jumbles of numbers, right? And you read the top of the press release, read the bullets, you read the quote, and you've just been bombarded with 100,000 different numbers and partial results and people have sometimes will rush a hot zone and give you a partial result, and then the next press release has the full result, and then you're being reminded of another result, and then there's another result still to come, and so it all gets a bit sort of confusing. So we try to avoid that and try to give a clear narrative as to what the drill results represent and why they're important. But again, having said that, I don't think we're doing anything that's particularly off market as to what everybody else does.
What percentage of the financing is budgeted to go into drilling and field work versus G&A? I mean, not only the financing, but you said you've got about $16 million. How much of that is going to go into G&A versus drilling?
Well, our G&A is pretty light, so I would say it's at least 90% going into the ground. I mean, at least. Our G&A, when I get that question, I always point out the fact that I'm taking this call from home. This isn't my expensive downtown Toronto office. This is the back of my house. our head office is actually in Rwanda
Mm.
at the project site, right? The core shack is attached to the head office, and I'm up there every 2 or 3 weeks for a few days. Uber Parambashar, our CFO, works out of there. So we're a small team, and very focused. So our G&A is not particularly high. So it's at least 90% of that financing is in the ground, at
Mm.
least.
Okay, but no immediate need to ramp up that gene, like do more marketing or anything as to your planning in the meantime.
Yeah, our IR budget certainly has gone up. We're about to put out our Q1 financials, and I was looking at that number, and certainly our IR budget this quarter is much bigger than it was the first quarter of last year. Um, so we are doing a lot more of that. We have been doing baseline environmental work. We have been doing um, engineering studies. We did that milling assessment with IM Gold, did the metallurgy. Our MOU with IAMGold begat the milling assessment, and the milling assessment has now begat engineering studies to understand a mine plan at O'Brien at a PEA level, and that's been an ongoing thing. So we are doing that type of work, and of course the environmental baseline work is with a view to the timeline for development, and so we've started on that. So there are expenditures now going on that type of thing. That's generally financed out of hard dollars, flow through dollars, almost exclusively drilling, although the Liberal government in Canada is now talking about making studies and engineering work eligible for flow through, which would be great if that happens. That was an election promise. So very low overhead though. I mean, I think we're probably under $1.5 million all in annually for overhead in this company, and that includes accountants, filing fees, legal, insurance, and non-flow through eligible salaries. So we're pretty lean, and I think we get a good bang for the buck in that regard.
Right. I know you only have a couple of minutes here before you have to leave. Has your opinion on doing a PEA changed since we last spoke, and doing or publishing an updated MRE in terms of the timelines behind it?
Yeah, publishing an updated MRE. What we said in that press release last week was, by the time we finish this current round of drilling, we've done 90,000 meters more than the previous MRE. But those will be 90,000 meters where individual drill holes are changing the story, right? We can put one deep drill hole down below, 500 meters below the ore mine, hit gold, and that changes the story. So the drilling we're doing right now is really impactful. So we're not going to down tools in the middle of that. We're not going to down tools in the middle of these big step outs and have a cut off and do an MRE, right? Because it's going to change instantly. So we are giving as much guidance as we can directionally as to where we think it's going, but we're going to do it properly, which is do this type of drilling, complete it. We're now, we know what we're doing, where we've got everything live. So we've got our leapfrog models going. Every drill hole goes into the model. We press the button. We know what's happening, and we can see good stuff happening. And so we're not going to down tools and just, it's the difficult thing to do. I've been in a situation before to do an updated MRE in the middle of a changing story, and it's changing. But there will be an MRE that comes at the end of that process. For the PEA, nothing has changed since we last talked, right? We've always seen this project as ore supply for somebody else's mill.
Yep.
There are multiple mills in the region. There are two right beside us, and there's one that's been the focus under that MOU with IM Gold and the milling assessment and the met work. So that work is well advanced. There's a good mine plan here. With O'Brien, the existing resource supports a pretty healthy mine plan on the basis that it goes to somebody else's mill. And so we want to understand how and in what context that gets put out there. We need to understand how we put out a what if engineering study? What if this happened? Or what if that happened? I don't want to put out a study for a mining scenario that we don't want to do. The work is well advanced. It's still going on. We're very encouraged by what we see. Very encouraged by what we see just on the existing resource, knowing that it's getting bigger. So, and want to properly have that done and completed, that work in the right development context. That's probably the best way of saying it, right? I don't want to put out a study for a scenario that isn't realistic or isn't going to happen. And so I don't want to put out a standalone project that shows us building our own mill, for example, because I don't think that's what we're going to be doing. So that's a work in progress. And I probably shouldn't say any more than that, other than it's well advanced. We like what we see. Look, Antonio, one thing I'll close this off because I do have a bit of a hard stop here. I was at the Canaccord Mining Show in Vegas last week, and I was on a panel of Northern Hemisphere developers. So we had Probe Gold there, we had Rupert Resources, Dakota, Liberty, a bunch of other companies. And Peter Bell, the analyst at Canaccord, asked me the first question, and he said, "You guys you're all new. You know, Matt Manson, Pierre Baudouin, Michael Gentili's relatively new. Peter McPhail joined the board. You know, what do you guys see in Radisson that hasn't been seen before?" Because the company and the project's been around for a while, and what I said was, we all need to see a mine. Right. We've all joined Radisson and we're all involved in this because we see a mine here. We're not here to drill this thing for the next 10 years. It's not an exploration story for exploration's sake. And so this PEA that we've been working on shows that mine. And it shows the mine on the basis of this ore going to one of the existing mills in the region, which again is the hub and spoke way that mining in the Abitibi has been done forever, right? These mills go for a long time and multiple ore bodies will go through them sequentially. So that's how we see this. And I think we are wanting to make sure that when we are in a position and able to disclose that work, it's disclosed the right way in the right context and shows a true statement of value of the project.
Well, I appreciate your time. I know you have to go now, but it seems like we're going to have a couple of more updates over the coming months. So thank you so much for doing this. If I'm forgetting something, people should let me know and I'll ask you next time. But thanks again for sitting down with me today, Matt.
Thanks, Antonio.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, Many out there do, and you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there, so it is safer for you anytime you're watching any type of company-specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias, again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing, and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Also, unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."